We are live, Pat. So once again, welcome to our millions of viewers. We hope that we're not going to blow up the server at YouTube. Last week, we were at 1.8 million watching us. And just to clarify that, we had 8 people actually watching us, and then, of course, the million that you and I make up. So,
yeah.
So I want to make sure that our numbers are real when people And I got another interesting story, completely off topic, Pat, which is usually your job, but I'm going to switch it to David. But so I started making political T-shirts for fun, right? And I started a Facebook page called Elections 2020. And so I'm going to share one of the T-shirts that I put up because there's a story behind it. And so here's my T-shirt. Trump or Biden? Alex, I'll take anybody else for 200, please. So I've got a bunch of those, right? And so I ran an ad on Facebook tied to my Facebook page that said Elections 2020, and Facebook rejected it. And they said that it was political in nature, and I needed to sign up as a political entity. And they mailed me a card with a coupon on it, and I had to put in all this information. I had to put disclaimers, and they still wouldn't authorize my ad. They wouldn't do it. So I thought, well, did they not even read the shirts? Because I'm poking fun at everybody. I'm not like advertising for Biden or advertising for Trump. I'm just poking. I've got over a dozen shirts. I'm just having fun. In fact, I'm going to put the link in below. People can take a look at it. But so this morning I thought, I got to outsmart Facebook. So I made a page called Humor Design and put the same link for the T-shirts on there. And then I got approved. So I thought that was pretty funny. So I know.
You wonder if they're censoring or not?
Well, I had to kind of circumvent the system because when they saw Elections 2020, they thought I was, promoting different candidates. But when I changed it to humor design, they don't give a rip. So I thought that was pretty fun. So today's numbers are just like last week's numbers. We are frozen in time in Arizona real estate. And we are at new listings. We're at 8376. We dipped below 8,000 on Tuesday, again, like 7,800. And so for the week, we had 4,160 new listings come up and 4,029 went under contract. And some of the interesting thing, now when I read these numbers, it's going to be different from what you see the multiple listing service report or title companies or anybody else. So for those that are new, let me explain what I look at. I don't count under contract accepting backups or contingencies as homes for sale. To me, they're already under contract. I just want to see what's active, right? So when I only look just what's active, I come out with, 8,300. When you add in under contract and contingency, you will end up adding another 5,100 homes onto that number. So that's how you're going to see something like 12,000 homes available for sale, when in fact it's not 12,000, it's only 8,300. The other thing is that they say there's a 2-month supply, but let's take a look at what's really going on. If there's only 8,300 homes for sale and we're selling 4,100 a week, how long will that last if we don't put any more listings on? 2 weeks. So in reality, we only have a 2-week supply of homes. And I had a past client send me a message yesterday, and she said, the house across the street went up for sale. She says, find me a good neighbor. And I said, well, that thing will be under contract by the weekend. And she said, yeah, it's been a steady parade of cars all day. And she said, why is that? And I looked up her neighborhood. She lives in Clemente Ranch. I said, there's only 3 homes for sale in Clemente Ranch, which is a popular little neighborhood because of the schools. So that part is continuing. But another number that jumps out at me is of all the homes that went under contract this week, only 180 of them are under contract with a contingency, meaning you have to sell your house, before you can buy the other one, right?
Mm-hmm.
So it's contingent upon the sale of your other house. 180 out of 4,100. That should tell you, if you're a buyer, nobody's interested in accepting an offer with a contingency. You're going to be in a bidding war. If you look at the list price and you think you're going to go in at the list price and you're going to ask for 2 points, and concessions from the seller, you're doomed from the start. You're not going to get your offer accepted. So I'm still convinced that as we get into fall and towards Christmas, that inventory will start going up, and we will see it going up every week going into 2021. And the real estate landscape, I think, is going to change dramatically. Congress and Senate went home. They got the Democratic convention next week, the Republican convention a week after that. They absolutely did nothing for relief. And this is after almost 2 months of Fed Chairman Powell telling them, if you guys don't kick in some more relief, we're going to be in deep doo-doo. And they don't seem to care that we're going to be in deep doo-doo. They all went home. So it's pretty bad.
That's pretty pathetic.
Yeah.
It's frustrating. It's frustrating when you see, been a frustrating time. I mean, I've been, frustrated. It just blows my mind. Not to get political here, but you wonder who they're really working for.
Yeah, I don't know. Not us, I guess. So I wanted to touch on a couple things today while I had you. One was, I want to talk about what happened Wednesday. So people stay tuned. I'm going to bring this up real quick and explain it. And then the other one is, I was asking you if you could show us what kind of fees to expect, because everybody shops rates, right?
Mm-hmm.
But then there's quite a variety of different fees that are out there from different lenders. So what should we watch out for? So I thought maybe you could kind of enlighten us with that in a minute. But first, let's talk about what happened Wednesday. The FHFA, that's a government entity that regulates Fannie Mae and Freddie Mac, right?
Yeah, basically the Federal Housing Finance Authority. They're basically kind of like the top dog over Fannie Mae and Freddie Mac. Yep.
So they just, without any notice, they just said, hey, any loans that close refis, not purchases, but refis that close on September 1st or after are subject to a 0.5 point fee, which on a $300,000 mortgage is $1,500. And for those lenders like you that already had loans in the pipeline, you couldn't pass that on to the borrower, right?
No.
So
once it's locked, they basically, the lender is the one. Basically, they said this point fees can be added on to any loans that are not delivered by September 1st. So basically, they came out Wednesday. So you're looking at 2 weeks to close a refinance, when normally it's taking the average lender a minimum of 45 days to close a refinance, because what's happening, Rick, is they got purchases and refis. Now I'm going to step back here. You know me, I zigzag around.
Yeah.
Lenders right now, if you had 100 employees at lender A, underwriters, processors, whatever, back a year ago, they got inundated. The problem with the mortgage industry is that when rates go down like they did quickly the last couple months, I'm saying they kept going down, and more people were refinancing. If you got those 100 employees working, all of a sudden they went from, say, having 500 loans that they're working on to, say, 4,000. I mean, their loan volume went through the roof. So what they're doing now is lenders are prioritizing. I see the turn times from lenders. It says purchases are 3 days in underwriting. Like this one lender this morning, they said their purchases are 4 to 5 days in underwriting. Their refinances are 21 days. So you just have to wait. You have to wait longer. But the problem is people are they're 2-3 times the volume, and an average underwriter can only handle so many loans. And that's why but bottom line is to go back to that, so they announced this fee on Wednesday. And they said you got to have the loan delivered. Would mean when it's closed, it's one thing for the client to sign, but then after about a week or so, that loan is packaged together in the closing department and it's sent to the investor, and they package it into a mortgage-backed security pool. So it takes about a week or 2 weeks after it's when they deliver the loan to the investor. So that loan had to be delivered by September 1st. So any loans that are locked, the lender is basically going to be eating the fee, the half a point fee. And you said that one lender was going to be over $10 million that they had to pay. And
yeah, there was no warning that this was coming.
No. See, if they gave a warning, that's the problem too. Is I was thinking about this. It's like if they would have said, okay, because typically what they do is when they make an announcement, they'll make an announcement and say, okay, for any loans that are closing November 1st or on or before, they'll give us some time typically with a guideline. Say, hey, we're going to tighten up this guideline, or we're going to be doing this, and this is due for any loans that are going close on or before October. Let's say October 1st. They usually give us about a month and a half to kind of like, okay, we got to rush. They might be closing a program up. Say we're going to close up this one FHA program, but so any loans have got to close by November 1st. They usually give you a time frame. With this, they came out. Nobody knew. I mean, even it was probably one of the best kept secrets out there. I think maybe a few people in some of the bigger lenders probably did. I'm sure word got out somewhere, but it is one of the best kept secrets because they just basically smacked it and said, hey, you're going to get half a point. And so even if you had your loan locked and people were locking loans, but then lenders they just added on the half a point fee to the loan. It's called a loan level pricing adjustment, LLPA. And those LLPAs are for credit score, loan amount, loan program, just all these types of loan, they have different pricing and pricing adjustments for different loans. And that's why people say, when you have a client that calls me and say, hey, my neighbor got 3%. I'm like, well, everybody's different because your credit score is probably different. You got probably different loan to value. You got 3, maybe you can get 2 3/4. So,
well, they came out and said that what I was reading in that mortgage, what's it called here? It's called the
Mortgage News
Daily. And yesterday they said this was nothing more than a money grab by the feds, that they saw that lenders had kind of put in some pricing and they said, hey, we want that. But they did it under the guise of saying we have to raise it because of concern over the economy. And it's like, what? We didn't have a concern over the economy last month?
Yeah.
Well,
it was basically a big money. It was a big money grab. I mean, I heard differing opinions. The guy from UWM, United Wholesale, said that the lenders did it on refinances because people were systematically refinancing. They refinanced at 3 3/4, and these lenders were getting, and it really does hurt the lender when you got Joe Smith out there that was at 4%, let's say last October, and he turns around in February and says, "Oh, I can get 3.5 or 3 3.25," and you got a lot of these online lenders. I'm not going to mention any names, but the starts with a Q. They have a tendency to go after people. Say, hey, you're at 4 now. We get you down to 3.5, and then when it gets down to 3 or 2.99, like, hey, we can refinance you at 2.99. You get some people out there are just habitual refinancers. That if they can save $50 a month, my feeling is it better be worth your time and effort. My feeling is you better be saving at least $125 to $175 or more a month to really, and it doesn't take a rocket scientist to figure out the numbers, but there's a lot of people out there that are taken by salesmen that are just trying to churn, hey, we can get you a lower rate now. We can get you a lower rate. I know you just refinanced. And that's what Steve from under UWM said, is that these lenders were getting hit with these prepayment. When they're hit from less than 6 months, the mortgage guy, I get hit with a penalty, early payoff penalty. I have to pay basically the check back to the lender if a client does. I have an internal prepayment penalty with a client. If they refinance in January and they call me in March, I have to pay back a lot of the fees that were involved in that loan back to the lender because they don't have time to recapture. It's basically a 6-month recapture period. So people, they're doing a disservice by doing, and I think that's what Steve said, is that they did this to penalize some of the refinancing, which I think there's a couple reasons why they did it. I think the bottom line is it was a big money grab that they're saying they got to they made $4.7 billion last quarter.
Well, are they trying to wipe out some of the smaller lenders?
Well, that's one thing that Mark Calabria, the FHFA director, he's got a hair up his ass somewhere, excuse my French, with some of these, he said, and I was on this conference, I was on this Zoom call with, not Zoom call, but just I listened to this webinar with David Stevens. He's head of one of the mortgage bankers, this MBA. And he said this Mark Calabria has got a bone to pick. And he said that things are going to start moving to bigger banks and thrifts. And I think he does have a point of contention to try to, knock out some of this competition. There's internal hate for some of these non-bank mortgage people like me. And he said competition is good. This is what guys like me are the reason why. If the big banks, like the big four, the one with the Stagecoach and some of the other bigger ones, if they were the ones that were just in business, you probably wouldn't see rates below 4.5 or 5, because they've got the competition is good. And he's got a bone to pick with some of these smaller mortgage companies. He does. And he just basically came out and said, we're going to do this. There's no scientific reason. And it's going to hurt, in the short term, it looks crappy. In the long term, if I have to talk to somebody about a refinance and say, you got to pay $1,500, on a $300,000 loan, you're paying $1,500 more. But if I'm taking their loan from a 30-year down to a 15 and taking their rate from, say, 3 3/4 down to 2.5, and like this gentleman I'm closing up next week, this refinance, he just originated his loan last year, bought a house. I am taking him from a 30 to a 15, and his payment is only going up by about $300 a month. But he's knocking out the number was like $180,000 in interest and payments. I'm knocking out 15 years of his mortgage. And he says, I pay extra anyway. I pay about $200-300 a month anyway. It's not going to hurt me. Let's knock this down to a 15. And he's tickled pink. So, the big picture, it sucks short term. It really frustrates the heck out of me because what the government's doing. I'm not on the government. I'm on the client side. I'm always for the client. I always say when I do a loan, I want to pretend like I'm doing it for my mom and dad. And it
had a short-term effect yesterday, right, on rates. So rates went up. Yeah, yesterday about 1/4 point, but that's kind of like just a knee-jerk reaction. We expect it to settle, right?
I think it'll settle down. Right now, I don't know if I can pull up. Can I pull up? Let me see if I can. Bear with me here. If I can find it here.
Yes, because I was reading it this morning, and it said that that the that everybody just kind of had a knee-jerk reaction and rates went up, because now they gotta cover this surprise 0.5, $1,500 per loan, or more than that, and so they just immediately added some pricing in there. And so,
can I share my? No, can I
share?
Yeah,
let me add this. Okay, it's up.
Yep. So they basically, this is today. Basically, as you can tell, the rates have had a good run. Let me see here. Last quarter. This is, once again, to reiterate, to show the client, the millions of people are watching this. This is where, right here, this was a crazy time. This was just, I talk about schizophrenia. I've never seen 20 years a time like this. And all of a sudden, the government said, okay, we're going to start buying mortgage-backed security bonds right in here. And look at this. It's been just steady, right in here. Rates have been really just, here was a good run right here. This last week where it topped out. And then I follow this pretty closely. It's like watching a stock. But you see here, this was a pretty good hit. This is, right in here. This is not the last couple of days have not been good, and this is where they announced. I mean, I think it was that the day 8/13? No, it was 8/12. It was right here. Basically, it was right here. But then this day they the lenders made an adjustment. So, I mean, but if you look at it, I mean, overall, I mean, I'll show you. I'll flip this around if I can. Let's see here. Where did I go here? Give me 1 second here. Oh, give me 1 second. I'm trying to bear with me here. Let's see here. Give me 1 second here. Hope I'm not boring the hell out of it, everybody. But so, let's see here.
So the red line when it goes down meant that rates went up.
This is the 10-year bond. So basically, they went. If you look at it, let me see here. Give me 1 second. I'm just trying to figure out the screen here. I mean, you go. Let me see here. Sorry, I'm using 3 screens here. I mean, you still look at this is where the 10-year bond has been. Come on, give me 1 second here. Sorry. You still look at it. This is back,
by the Fed.
That's why we're still on the bottom, huh?
Yeah,
we're still on the bottom. So I mean, rates are still. I think we're going to settle back down again. I mean, this news was not good for. It was not good short term. It just was frustrating. But I think it's just it's a big money grab. It's a big money grab.
Put up that chart that you were going to show us when we're comparing fees.
Yeah. Okay. Here, I'm going to do this. Give me 1 second here.
When people,
what I'm going to do is I'm going to go behind the curtains when pricing a loan and tell people, because people call and say, "What's your interest rate?" And then they hear, I'm gonna go behind the scenes a little bit here on my pricing model, and show basically when somebody calls me, I put in their DTI and their FICO score, basically, and then put in their debt to income ratio, and then their lock days, and then I'll pull this up and I'll show you. My job, I believe, on a daily basis is to try to find the best rate that people, because let's face it, there's thousands and thousands of lenders out there. It's insane. I mean, it's just absolutely insane how many people are, let's see here, how many people are in the mortgage business now. There's a ton of people that got in this business. It's very confusing by Joe and Mary Smith who are trying to buy a house. They see this one interest rate advertised for this and one interest. And it's just people focus on the rate, which I get it. They want the best rate. Nobody's ever called me up and said, "Hey, I want the highest rate and your highest fees because I like you a lot." And that's, it comes down to rate, speed, and service. And now, can you see this chart?
Yeah, it's a little
blurry,
a little eye challenging.
Okay. But these are different investors that I've got, that I've got access to. Let's see here. That I've got access to. These are different investors, so I try to, see which investor might be, like this, Homebridge, good lender, they're coming around. Being a broker, these are the options I have based on this scenario of 450,000, 5% down, 786 FICO score. These are all the investors that I've got. And now this lender, this top of the chart is basically the best priced lender. But some of these lenders, but like Flagstar, they're slow as heck right now. They're like, it take you 60 days to close a purchase. So that's probably, I'm not going to go there. I'm going to probably maybe go to let's say this Parkside. I'm going to pull this up. Now, can you see those? Can you see those numbers here? If I can blow it up a little bit, I don't know if. Here, I'm going to explain it, okay?
Yeah, explain it for us.
Okay, right here. Okay, if I said, right now I'd be looking at somebody said, "Hey, you're probably looking at 3.25." because right here, at 3.25, I give them a credit of $2,300. Now, the people who are watching this, I'm trying to give you an explanation of. People say, "Well, I saw this rate, 3%." Well, I can get you 3%, but now I went from giving you a credit of $2,300 to charging $1,400. So that's a $3,800 difference for only a quarter point in payment. Does that really make a lot of sense? And you see here, 3 1/8 is like $17 credit, but then all of a sudden I go to 3 1/4 for an eighth more. I can get you $2,300 in closing costs paid. But you see the difference in how it stepped up. And now, if I was going to price it out, I'd say 3 1/4 is probably your best rate right now with this Parkside lending.
Now, do we see that if we go to big banks like the one with the Stagecoach? Or do they just have like one flat rate for the day and one fee?
They'll just give you one flat. They'll say our rate today is 3%.
Okay.
You can probably get into more conversation. That's the problem, is when people call centers for some of these online lenders, I try to give people options based on how long they're going to be in the house, how much money they got to work with. I ask different questions like that, because if they're only going to be in the house 3 or 4 years, but they need some closing costs. Yeah, maybe I'll give them 3 1/4 and give them $2,300 credit right here. Or if they really are short on cash, I'll bump it up another eighth and give them another $1,800 to $4,100. That's what this is where people say, "Oh, I got a no cost loan." What they're doing is basically just bumping the rate. Okay, at 3 5/8, I can give you $6,000 credit. So basically, from 3 1/8 to 3 5/8, a half a point difference in rate, I can give you $6,000, over $6,400 in towards your closing costs.
But you can give the consumer a lot more choices than the online people and the big four.
Oh yeah. Oh no.
But on top of that, then you're just talking rates right now. But don't we also see some considerably higher lender fees out there, or considerably lower, depending on where you go?
Oh yeah, yeah. I mean, a lot of times they'll charge. I've seen some loan estimates where they're getting say 3%, but they're getting charged a discount of say $10,000 down here. I mean, they're getting 2 or 3 points charged to them. It's very easy to look at a loan estimate and say you're getting screwed. I'm just going to be.
Well, we saw one that we personally worked with where the buyer wanted to switch to one of the online ones and was moving over real quickly for different reasons, and we took a look at it, and I believe that their total fees for that loan for her were going to be $3,200 versus yours, which was going to be, what did we end up settling on, $1,200 or something?
Yeah, my difference typically has been about $2,000 on conventional side. Yeah, I mean,
so people need to ask the question. So we're always asking the question, "What's the rate? What's the rate?" You need to add a second question to that. What's the rate? What are the fees? Yeah,
and a lot of people, when people say fees. The problem I find out with people, your fees on the mortgage side are origination, appraisal fee, underwriting and processing, and that's about it. I don't have an underwriting and processing fee. And then there's title fees. And then the other stuff that people lump into fees are the taxes, the escrow account, the insurance. Those are monies that are still involved in the deal, whether you're getting a loan or not. So those are really, you have to take a lot of people, the average person will just lump like, "Oh, I see all my fees are like $12,000, but they don't realize that probably, $4,000 or $5,000 or $6,000 of that, or might be taxes, escrow, HOA.
Yeah, they're going to vary greatly on the price of the house and how much the HOA is, how much the taxes are, et cetera.
Yeah, exactly.
But then the other part is that the title fees are pretty standard across the board.
Yeah.
You have to buy title insurance, and title insurance is split between the buyer and the seller. It's mandated, right?
Yep.
And the prorated taxes that you have to pay, that's mandated. You can't get away from that. So the only real wiggle room is any agreement that you have, if you happen to get the seller to contribute some money towards your closing costs, which in today's markets,
Yep.
practically impossible. And people like, I could sell my house in a day. Why am I going to contribute to your closing costs? But in a normal market, that's some of the things you can do to lower, your escrow charges and your title charges to get a contribution. But in shopping for a loan, I think it's really important to stress to people that, we have people that are shopping online and they're looking at a rate and they're talking to someone on the other end, and they don't see the additional fees until they get their first estimate and they've already got their toes dipped in. Whereas they don't ask the question up front, what is the rate and what are my fees to get that rate? And so there's a lot of different ways to shop around to make sure that you're getting, full transparency. So I think we're just telling people be a little more diligent up front and cautious.
Well, I don't think, honestly, I don't mind people shopping me, because, I'll say, hey, I just tell people, listen, if you call 5 different lenders, you're going to get 5 different quotes. And you got to go with somebody that's comfortable, that you're comfortable with. I mean, you know me, I'm about as transparent as you can get. I mean, that's why I'm showing people different pricing, my pricing engine. You're not going to see, and I'll show people that when I'm doing a loan for them. Say, hey, listen, here's my pricing. I can show you, going from 3 to 2.99 is going to be a big difference. So I'm very open about it, because if somebody's going to shop and said, there's somebody that's an eighth better than you, I mean, you could do that all day long. I mean, even if you get the lowest rate, you're going to find the next day somebody who's a little bit lower than you. So, I mean, there's I think a lot of people are, they get nipped. I get it. They want the lowest rate. I get it. But as soon as I lock it, they could probably go out and find 4 or 5 different lenders. Even though I'm a broker and my rates are very competitive, they could probably find somebody still that are, maybe an eighth or quarter point lower. I mean, I was picking up something here, from Mortgage News Daily, and they said that, and I'm just reading this. It says some mortgage companies have generated buzz by advertising the 30-year 1.99 rate. While it's possible to obtain such a rate, there is definitely a catch. That's what they go on to say. Rates are certainly low in the big picture. Up until this week, they were never as low as they have been. The average lender can do it in the high 2s range for the ideal scenarios. But it says that situation has deteriorated, the last couple of days. But they were talking about how every lender, you can buy down a point, 2 points, 3 points, you can get down to 4 points. But is it really worth it? I mean, they say the bottom line is, the takeaway on this that they said in this article is that the takeaway is that someone could certainly advertise rates at 1.99 with multiple discount points in a market where the going rate is actually 2 3/4 with no points. But it said here, the advertising lender is no different than the competition. That's a key point, because all they're doing is advertising their, the lowest rate to get you to call. And they're no different. Like I said, Quicken is no different than me. They always make it sound like they're the lowest, but I've seen the loan estimates be crazy sometimes on their sheets. So bottom line is, it's all about advertising. They're not going to advertise the highest rate. And
and it's not really a bait and switch. It's just, we can get you that rate. However, here's the fees associated with that.
I always tell people, buyer beware. I mean, if you see a rate that's ridiculous, because I've had people call me and say, hey, I saw this rate at 1.5%. I go, right now the going rates say 2 3/4, 3%. There's something there. If it's that good, there's something going on if you have to read the fine print. And, the rates and fees can be moved around. As I showed you earlier about the buying the rate down or up. I can play around with the rate and the fees. Okay, you want to lower. I always say rate and fees being equal. You want a lower rate, your fees are going to go up. And if you want lower, if you want lower fees, your rate's going to go up. So my goal is to find this. There's a sweet spot every day on interest rates where it's like, okay, if I go up a little bit here, I'm paying it too much here. Let's lower. Right here. That's the sweet spot. So it might not be the lowest rate, but I look to see, like you said, once again, how long people are going to be in a house, how much, because people want the lowest rate. I'm amazed at how many people, people say I'm going to be in the house for 15, 20 years, then I'll buy the rate down. but they're going to be in the house 3-4 years. It's a waste of money. So,
well, the other fees that you run into too, the upfront fees like appraisal, does that vary by lender or is that pretty standard?
it varies. Actually, it varies by lender, but more importantly, it varies by the size of the house, where the house is. I've seen, you brought that point up the other day when we started talking about the topic today. Typically, your average appraisal fee will be in the range of $475 to about $600. Some lenders have a standardized, like my old company, they had a standardized, I think $475 for conventional and $550 or $575 for FHA. But then that always varied too if they had to go outside to Pine Top or to Flagstaff, or right now appraisers are so busy that their normal charge might be say $450, but they're going to say, okay, if you want this, we want this appraisal done in a week, I'm going to charge you $675. So it's basically market demand now with appraisals. So
we can't really get appraisals changed, but if you get in front of it, sometimes you'll get a guy that's going to come and he's going to appraise a home in Arcadia, and he's from the West Valley. You have to ask the question, what do you know about Arcadia? Because the pricing, home values vary by street.
Oh,
and
yeah.
If you come from the West Valley and come into Arcadia, you're probably not going to get a good appraisal. And then in a wilder example, my friend that bought the house in Forks, Washington, which is way, way, way out in the middle of nowhere, towards the Pacific Ocean, his appraiser was from Redmond, which is a suburb of Seattle. And he got out there, and we don't know where he pulled the comps, but he underappraised them by $50,000.
Yeah.
And it really,
yeah, that's the frustrating part about it now is that everybody's so busy. There's so appraisers that are busy. You might have to get an appraiser that's going outside. Appraiser that lives in Queen Creek might be, appraising something that's up in, North Scottsdale.
Yeah, so it becomes even more important for the listing agent and the buying agent to, of course, the buyer's agent. They sometimes they're pretty giddy if it doesn't appraise because, hey, we can get it for you cheaper. But you want to give comps, so you want to leave comps that help you arrive at that price. What made you price this at $475? Well, it was this list of homes right here, and you leave that for him. It doesn't mean he's going to use them, but he's going to take them into consideration. So the appraisers can see if you can get in front of it. So the fees are they don't really vary by lender per se. They vary by the location of the house and the price of the house. But if you want the transaction to go smooth, make sure that the real estate agent is getting proactive with the lender or the appraiser instead of just sitting back going, well, we'll just see what happens. Because once the horse is out of the barn, there's not a lot you can do. No,
exactly. I agree with you. So yeah, they do. The fees do vary. I mean, but like I said, it varies by maybe a couple $100. But I think the biggest thing that people have to look for on my end when you talk about fees and rates is the biggest thing I've seen is the biggest, and I'll just say this, the biggest, what's the word I'm looking for? Misuse of fees by the lender is discount fee. They're like, oh, okay, we're going to charge him $7,000 in discount. He wants 2.5. We're going to charge him, it's $7,000. They don't tell, and that's what people call online. They call in to a call center. You're talking to a guy who's at a call center. Say, if you tell him, hey, I want 2.5%. Like, okay, that's 2.5%. You want a 2.5% interest rate? They'll send you a loan estimate with $8,000 discount points. And then, but he didn't tell you that 2 5/8 or 2 3/4 is about $5,000, $6,000 less because there's big jumps in rate. And rates depend on the lenders have a certain appetite for interest rates. They might they might want a note rate for 2 3/4, or they might want 2.99. They might, or I'll give you an example. There's one lender that I was using, United Wholesale, at 3% was X amount of dollars for discount. But if you went to 2.99, that was the better deal. And it was just, you're talking about 10 basis points. I mean, it's just ridiculous, but they wanted the 2.99 note rate for their portfolio. So they're going to price out loans accordingly, because I can almost tell when I look at a rate chart, what rate the lender really wants to pull in, by how much you're giving or how much the credit, discount you have to pay. So
I want to share another chart that I found this morning that was showing. Can you see that okay?
Yep.
So I want to point out this area right here, which the red line shows interest rates down here in the 3, right?
Mm-hmm.
The blue line shows growth in loans. And now we're seeing that line go down and kind of uptick a little bit, but we're down almost 4% from a year ago. And according to the analyst that was putting this on today, he said, when you have a gap like this, that this blue line is not going up while this line is still way down here, it tells you that interest rates are not low enough yet to get this to grow. And that's a concern for housing, that this line, if we're really going to grow the economy, and we are a debt fueled economy.
Mm-hmm.
If we don't borrow, nothing grows. So and that's a whole different discussion. But this blue line needs to be moving up like it was here and like it was here. See how
Mm-hmm.
rates went down and sales went up here?
Yep.
Okay, or as rates went down. Well, we went way down, but we're just kind of muddling along, down 4% from a year ago. So, which is right. So basically he's saying, don't be surprised if we're at 1.5% next year.
Wow.
Shocking, but
there's
no velocity.
There's no velocity. And that's what the lenders are trying to, that's what's hurt the lenders the last 6 months is the early prepayments. When people did refinance at 4, then they refinanced at 3.25. Now they're refinancing at 2.5. They're paying off these loans and these lenders. And that's why it probably goes back to that 50 basis point hit. That's what I got somewhat of an explanation, is that they're trying to penalize people for, because these lenders buy a loan, they pay for $100. As simple as this, as for $100 worth of money, they pay like 103, right? Now in 3 months, they paid that 103 for the $100 worth of money. Because basically what they do is they have servicing rights. If they paid 103 for something for 100, and that got paid off, well, they just lost 3 points 3 months later. And that's what's happening with the lenders, is they pay a premium, and when they get paid off quick, it hurts everybody. That's really the bottom line. So,
well, next week,
hopefully I made some sense today on interest rates. And
well, I think the key takeaway is the ability to shop. That you're able to go and show these fees. This fee means this fee means that. Let's find the best product for you, instead of just on the phone going, yeah, I got 2.7.
Yeah, exactly.
You have to have that discussion about the fees. So buyers out there, when you're looking, find a lender that will openly discuss the fees and the different options that are out there for you. If you just concentrate on the rate and you turn a blind eye to the fees, you could get blindsided. So I think, and I expected this week to be a quiet week, as you did too, but I had no idea that Wednesday was going to do what it did. So that was an interesting day. And real estate in my world right now, it's just, man, it's tough to find somebody a home. It's just really brutal, and so, but if you're thinking of listing at all, I don't think that party's going to last much longer than the next 90 days. Has nothing to do with the election. I just think that, thanks, Jared. I think that things are going to turn, and we're going to have a crash. I keep saying over and over again, I don't know, but we're in a frenzied market, and frenzied markets don't last. My brother called me yesterday and said his son wants to buy a home. He's in Seattle. And I said, tell him to wait. I said, if I'm right, we'll know by October, November, December and we start seeing the numbers change. If the numbers don't change, he's still not in trouble. It's not like home prices are going to go up that fast. But I said, don't send your son out to buy a home where he's got to outbid 15 people.
Yeah. No, I agree with you. I've been doing this. I've been in finance for 30 years, been doing mortgages for 20. And I agree with you. I don't think that this frenzy we can't keep going on for another year or two like this. I mean, it's just, there's no way. I mean, people are going to start breaking down even further. I know underwriters are stressed out. I mean, working, 15, 16-hour days. Processors are, everybody at our company, we did like 325 loans last month for a small office, which is,
But you've got a fear of ramping up too. I mean, you don't want to add a lot of staff because it's not going to last.
Well, that's the thing. That's the problem with the mortgage business. You can't just ramp up quick when you get rates. That goes back to my point. You can't ramp up quick and hire people because you got underwriters. You need seasoned underwriters that know what they're doing, processors. So it's not like, and when things are busy, people are not moving around. They're just saying, hey, I'm busy. I'm making money. I'm not going to go anywhere. So that's what's putting even stress on even more. And that's when our company, we've been hiring, but very prudently, because when it turns around and goes the other way, then you got people that you got to lay off. So
yeah.
It's a tough, I mean, people just have to be patient. Like you said, purchases, the turn times are decent, 3 to 4 or 5 days in underwriting. Some banks say they can get it done 24 or 48 hours. Yeah, you can get it done. But refinancings are taking, some of the bigger banks, I'm hearing 120 days for refinances, 4 months.
Because they don't want to do them.
No. Yeah, you're right.
They don't want to loan you any money to purchase your house either. You can't get in the big four. There's no way you're getting that loan closed in less than 45 days, if that. So, that's another piece of the puzzle and a conversation for another day. But well, thanks everybody for hanging in there. The 1,008,000 people that we had watching, and this always replays. The live video takes YouTube about 2 hours to process the video and then put it back up in my feed so you can watch it, tomorrow. And take a look at my T-shirts. My Facebook story that I was talking about earlier, that Facebook was not going to let me advertise my election 2020 T-shirts, and I'm poking fun at everybody. I had a gal that put a comment on my page that I was not including the Libertarian candidate, and I said, well, have you actually read the shirts? Because I'm not picking on any. I'm like making fun of Biden, making fun of Trump. And she says, well, we could use some support here. So I looked up the gal's name, Jo Jorgensen, and her slogan is time for change. So my T-shirt says, finally, a solution for the coin shortage. I don't think that's what she was looking for. So, everybody have fun. Pat, have a super weekend, huh?
Yep. You too, buddy.
Okay. See ya.
Here. Bye-bye.